Hello, everybody, and welcome. Today, my guest is Nivedita Sunil. Nivi is an emerging markets analyst at Lombard Odier Investment Managers. Welcome, Nivi.
Thank you, Thomas. Thank you for having me.
Nivi, today we want to discuss recent developments in India. So India has not come through the corona pandemic as well as other Asian economies, especially China. What have been the reasons for this?
So Thomas, while both India and China did impose early lockdowns, you're right to say that the effectiveness in handling the pandemic varied quite widely. I think principal among this was the fact that China's pandemic was initially focused only in Wuhan, while India's was already economy-wide by the time it was fully discovered. The second reason is that the response was controlled quite centrally in China, so the implementation was extremely strict. So centralized quarantines relied basically extensively on surveillance and testing. So community officials would go from door to door checking families and then quarantine anyone with symptoms regardless of consent and, essentially for the greater good. So Wuhan essentially credits this practice with helping it end its pandemic. Now, India is different because it has a different structure. It's a much more of a federal setup where the states have a lot more power. So I think that was one of the core reasons why the lockdowns were not as effective. Now, in addition to that, I think the fact that the lockdown had, very little notice before it was actually imposed, I think it was 3 to 4 hours, meant that there were also a lot of challenges in execution. And so, it did not pan out as well as China's situation. Now, also during that lockdown, so during the 3-week period, there was also a lack of testing and inadequate contact tracing, which obviously China did much better in the initial parts. Whereas, in India, during the lockdown, there were 2 daily tests done per 100,000 people. So obviously from that perspective, India lagged a lot in the response. What I do want to say, though, is that if you look at the current situation, we actually think that India is on a much better footing going forward, especially given that the vaccine situation and progress has been quite encouraging so far. So unlike in a lot of other parts and other emerging market economies, the supply of vaccines is not an issue in India. And the government has finally sort of, increased the pace at which it's distributing the vaccines, which is extremely promising from a medium-term perspective. So despite the fact that we're in the midst of a second wave, we are actually quite positive about the medium-term effects on India.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. So India's budget deficit is at a new high, but it seems as financial markets appreciate that. Crazy word. What does this tell us about the current situation?
So, you are right to say that, India's fiscal deficit was likely around 14% of GDP in the fiscal year that's just gotten over. And it's probably going to stay relatively high, around 11% or so in the next fiscal year as well. However, the markets have taken it well because underpinning that and the optimism of the markets is actually the quality of the budget that was unveiled in February, and alongside some of the structural reforms that India has done over the past few months. So the new budget, which I think is really important, has finally focused on the right priority for India, which is long-term growth. So, India, if you just take a step back, has a large demographic dividend. So 12 million there's a 12 million people rise in working age population every year, and 45% of the overall workforce is largely in unproductively employed sectors like basically agriculture. So what that means is India needs to add a lot of jobs at a very fast pace in the coming years. So just to absorb the incremental labor force that India has, it needs to grow at close to 8% every year. Now, because of that, the focus on long-term structural growth is extremely important. And so there have been many structural reform initiatives that have happened over the past year. And just before that, such as the cut in corporate taxes, increase in FDI for different sectors, production-linked incentives, and so on. Now, turning to the budget, in addition to that, basically the deficit expansion, while it is a big number, is very capital expenditure focused rather than welfare focused. So CapEx spending is going to increase by 35% year year on year. And essentially the multiplier in capex spend is obviously much higher than welfare spend. And so the hope is this will boost investment growth in the coming years as well, and contribute to sort of a revival in private sector investment in the coming years. So if you take this sort of fundamental shift that's sort of envisioned in the budget, I think it sort of positions India quite well for a strong growth rebound. And that's sort of why the markets have taken it quite in their stride. There are also some other parts of the budget that are quite promising around, further banking sector reform and cleanup, which I think also, the market has taken quite well. But, taking a step back, for India, it's always going to be about execution. But then I think the most important starting point is the policy prescription right or not? So have they got the right policy prescription to position India to have a shot at sort of getting those high growth rates? And the answer to that is, and so I think that's why markets have been quite buoyant in response to that.
The Indian bond market is considered to be very transparent by international investors, and therefore they're shunning direct investments. What has to change that there's a higher awareness for Indian bond?
I think it's important to level set and just give a picture of the overall bond market. So the domestic debt market in India is about 67 percentage points of GDP. However, if you actually take a closer look, the corporate bond market is only 17 percentage points of GDP. This is actually because most of the lending to corporates goes directly to the banks and is done directly by the banks. To give you a sense for why this is the case, I think it's quite useful to look into the history of the banking system. So the banking system was nationalized back in 1969. And ever since then, because there is no social security net in India, guaranteeing returns for the public has become a political necessity. So despite having a high savings rate in India, most of the household savings are essentially channeled into the banking sector. And so retail penetration into capital markets is quite low as a result. So now coming back to the relatively small corporate bond market, most of the issuances are essentially by the infrastructure companies or financial services companies, and almost all of them are via private placements. So essentially the depth and the liquidity of the market is definitely lacking. So, most of the bonds issued now are either AAA or AA securities in the sort of local rating agencies. And so the pricing mechanism hasn't really been perfected either in the local currency side. Now, there have been efforts to sort of improve this, such as sort of the Insolvency and Bankruptcy Code. The RBI has a large borrower framework that it introduced a few years ago. The SEBI has a framework for enhanced market borrowings. But then at the end of the day, you will need to see much more of a push along these lines to see a significant rise in the bond market penetration. Now, you asked me, what does it take for it to change? And you essentially need to see three major things. One is the supply side encouragements to come to the capital markets, right? So like I said already, the SEBI has encouraged large corporates to essentially borrow 25% of their overall debt needs in the capital markets. Now, in addition to that, you need to see a lot more reforms, such as, facilitating trading and secondary market liquidity, CDS development, corporate and government bond repos in order to facilitate that liquidity. The second thing is structural reform. So IBC, again, that helps a lot with resolution, pricing, and improvement in payment culture, and that's already underway. And then the last is the demand side increase. And so for the third one, you have seen an increase in mutual fund penetration in the national pension scheme in recent years. But again, government securities take up a large proportion of that market. So I think India also should be taking more steps to engage with international investors. And that can happen typically on a sustained basis if they go forward with index inclusion. So then that allows a lot more foreign portfolio inflows to come into the market and gives that room for the market to expand and sort of, generate a little bit more liquidity into that market. So I think from a structural perspective, the authorities are aware of it, and they are trying to get sort of Euro clearability for the Indian government bond market. There have been a few more reforms that have happened that we can go through if you're interested in, but essentially, they are trying to open up the market, and over the next sort of year, 2 years, if that results in an index inclusion by the major providers, then that could form a very solid base of diversification that will allow the corporate bond market to also deepen a lot more.
So how did the Indian bond market develop during the COVID-19 crisis so far? How about spreads and default rates in India?
Yeah, so I mean, during the crisis, the Indian bond market practically shut down, right? So the past default of ILFS and DHFL had already affected the confidence in the market, and the closure of the Franklin Templeton's corporate bond fund during that time led to even more credit risk aversion. So, in general, market participants were quite worried, also because there was a 5-month loan moratorium, and the market was beginning to worry about how much that increase in non-performing loans would be and whether or not that would be manageable. So based on our sources, we've seen that spreads widened out by about 100 to 200 basis points during the peak of the lockdown. But since then, a lot of that has normalized as the government stepped in with their fiscal efforts. So some of the initiatives that the government did in order to normalize the stress in the economy, such as supporting the MSMEs, providing, which are the micro, small, medium enterprises, special liquidity for the non-bank financial corporations, some more support for power distribution companies. All of those help to sort of unclog the liquidity in the system. And so now I think the situation is on a much more stable footing. You also asked me about default rates. So the default rate frequency is not published as widely, but it has been hovering around about 4 to 5% over the last 8 years or so. But given the opacity around the market, it's hard to sort of come up with precise projections on where exactly it went, especially during the crisis.
So the Indian financial system is considered to be in need of reforms, especially in dealing with bankruptcies. So to what extent is this a burden for the Indian economy and international investment activities in India?
Yeah, so I mean, I think, look, bankruptcy reform for sure is key to the long-term progress of the country, because that will help, as we sort of discussed, with the deepening in capital markets. And, with the introduction of the Insolvency and Bankruptcy Code, I think very good progress has already been made. And now there's also some, in the most recent budget, an asset reconstruction company that's being talked about in terms of being set up, which will also help with sort of the resolution proceedings. So let me first talk about the IBC, right? So right now, through the IBC, we have seen around 4,000 cases that have been admitted. And during the crisis, basically COVID crisis, the IBC was suspended for a year, but it's back up and running now. So if you look at what happened in terms of recovery rates for companies that went in through the IBC, they have been much, much better than what they were before. Now, IBC obviously was launched with a lot of fanfare, and they promised that a resolution would happen in 270 days. Now, obviously, that was an extremely high bar, and that was hard to sort of fulfill. But that being said, right now the IBC has sort of tackled all the low-hanging fruit that it can. So, the top 40 to 45 cases were 50% of the total banking sector's NPAs. Now that we've gone through a resolution there, now we're going to the smaller cases, and so the ability for the overall infrastructure to handle that is now going to be tested as it comes back online. But still, I think the most important positive from the IBC essentially is that it has led to a change in the payment culture among the corporates, from what it was before. Because this time, if there is no resolution, there's high probability that you will lose your business, which is very different from before, which was much more of a debtor-friendly sort of way of resolution. The second thing, if I can touch on quickly, is the asset reconstruction company, which is being talked about. I think that has the ability to sort of help the financial sector with a much faster resolution and much less time-consuming, and with a much less time-consuming nature than the IBC. But so essentially, right now the details are being worked out. I think they're trying to figure out whether banks will fund it. So is it going to be a private sector solution, or will the government add funding into this overall vehicle? But if executed properly, I think this has the potential to unlock a lot more investment, and a lot more international investors will come in and play quite actively in the domestic debt market, which will again help with sort of broadening out that corporate bond space that we've been talking about.
So this was Nivedita Sunil from Lombard Odier Investment Managers. Thank you very much, Nivi, for being with us today and sharing your insights.
Absolutely, my pleasure. Thank you for having me.